I mean, if you felt like you needed a neck brace after watching the markets this past week, you are definitely not alone.
Oh, absolutely.
We're talking about a week in early February 2026 that I think history might just label the Great Whiplash.
It was the textbook definition of volatility.
Yeah.
We went from the sky is falling
Yeah.
to, everything is fine in a window of about 48 hours.
Yeah.
It takes a serious stomach to handle that kind of G-force.
It really does. I mean, just look at the headline numbers we're staring at here. On one hand, you have the Dow Jones Industrial Average crossing 50,000 for the first time ever.
Historic.
Sounds amazing, right? A huge moment for traditional finance. But then you look over at the crypto charts for the same week, specifically around February 5th, and it's a horror movie.
Followed immediately by a romantic comedy.
Exactly. Bitcoin plummeted all the way down to $60,000. That's its lowest point since, October 2024. I remember looking at my phone and thinking, okay, are we going back to the Stone Age? And then, almost as if it bounced off a trampoline, it just surged back to reclaim 70,000.
It's a classic panic to power bounce scenario. But what we need to be careful about here is not just getting distracted by the price tags.
Right.
The prices are the symptom, they're not the cause.
And that is our mission for this deep dive. We aren't just going to gawk at the charts and say, wow, big red candle. We need to unpack the actual triggers. We've got a massive stack of sources today, analysis from FX Empire, market data from Polymarket and TradingView, some investor surveys from 1inch, and coverage from Finbold and Be in Crypto.
And when you lay them all out, a pattern really emerges.
It does. It's a mix of AI spending fears, some very confusing labor data, and a massive leverage washout that essentially just reset the whole crypto market.
And that washout is the key phrase. If you don't understand the mechanics of what happened on Thursday, February 5th, you can't really understand where we go from here.
So it wasn't just random?
Not at all. It was structural.
Okay, so let's start exactly there. Thursday, February 5th, the crash. Bitcoin touches $60,000. Now, for a lot of people listening, that number probably triggered some alerts on their phones.
Well, it triggered a lot more than just alerts. It triggered a state of extreme fear. If you look at the fear and greed index, it dropped to a 6.
A 6 out of 100.
6.
That's not just fear. That's like despair.
It's exceptionally low.
Yeah.
It signals that sentiment had completely, totally bottomed out. But here is where it gets fascinating.
Okay.
This wasn't just people deciding to sell because they suddenly hated Bitcoin. This was a forced liquidation event.
And that's a concept I think is it's so important to get right. It separates a correction from a crash. When we say forced liquidation, we're talking about leverage.
Precisely. In crypto markets, many traders borrow money to make bigger bets. That's leverage. But the exchange has rules.
Strict rules.
Very strict. If the price drops too low, your collateral isn't enough to cover that loan. The exchange doesn't call you and ask politely for more money.
No, the computer just acts.
The computer acts instantly. It automatically sells your assets to cover the loan. It's not a choice, it's a mechanism.
And when that happens to thousands of people at once, it just creates this cascade.
Exactly. The selling drives the price down, which triggers more liquidations, which drives the price down even further.
So how bad was it on Thursday?
We saw over $1 billion in long positions, so bets that the price would go up get wiped out just in the drop to 60,000.
1 billion.
And if you look at the total crypto market, liquidations hit $2.6 billion. That is billions of dollars of buy-side pressure just vanishing in smoke.
That's a staggering amount of wealth to evaporate in 24 hours. It sounds like the market just flushed the whole system.
That's exactly what it is, a flush. And the data from sentiment is really telling here. They differentiate between weak hands.
The crowd that panic sells or gets liquidated.
Right. And the smart money. And their analysis suggests that the moment the crowd panic sold at 60K, that was the bottom. That capitulation cleared the deck.
It's the old adage, right? The market transfers money from the impatient to the patient. Once the weak hands were out, there was no one left to sell.
And that's what allowed prices to rebound almost instantly.
And what a rebound it was. By Friday, February 6th, Bitcoin had rallied nearly 15% to get back over 70,000.
That was the largest daily percentage gain since early 2023. It's like the market held its breath underwater and then just gasped for air all at once.
But we can't talk about this drop in isolation. I mean, crypto doesn't exist in a vacuum anymore.
Not at all.
We have to look at the stock market, specifically one giant player that seemed to kick this whole thing off, Amazon.
This is what connects the crypto crash to the broader macro picture. On Thursday, Amazon dropped a bombshell. They announced a plan to spend $200 billion on AI in 2026.
200 billion just on AI. That's an obscene amount of money.
It is. And Wall Street freaked out. They saw it as excess CapEx, capital expenditure. Basically, investors looked at that number and said, wait a minute, you're spending $200 billion with no guarantee of immediate returns. That eats into our profits.
It's so interesting because usually investing in the future is seen as a good thing, but here the market saw it as reckless.
It triggered a risk-off flight when a giant like Amazon takes a hit, and the whole tech sector wobbled. Investors get scared. They pull money out of anything perceived as risky.
And crypto is still at the top of that list for a lot of people.
Exactly. Despite all the adoption, Bitcoin is still treated as a high-risk asset by the algorithms. So Amazon tanked, tech stocks wobbled, and crypto got dragged down right along with them.
It's a domino effect. Amazon sneezes, the NASDAQ catches a cold, and Bitcoin gets the flu.
Briefly, yes, until those crypto-specific mechanics, that washout, took over and caused the bounce we talked about.
Speaking of getting the flu, if Bitcoin was sick, it feels like Ethereum was on life support. The situation with ETH this week was intense.
Yep.
While Bitcoin had that nice bounce back to 70 pay, ETH had a much, much rougher ride.
It was a crisis for Ethereum holders, no doubt. ETH shed 40% of its value in just 10 days. It briefly dipped below $2,000.
Oof.
That's a psychological barrier that really hurts to lose.
And numbers on a screen are one thing, but there are real stories behind these losses. I was reading this report from FX Street about a specific whale known as Trend Research.
Right.
And honestly, reading the breakdown of their trade gave me sweaty palms.
Just a cautionary tale about leverage, plain and simple.
Just to paint the picture for you listening. This entity, Trend Research, had accumulated nearly 800,000 ETH. At the peak, that's worth about $2.59 billion.
A huge position.
But they didn't buy it with straight cash. They used leverage. They borrowed money to supercharge it.
Which is great on the way up. It multiplies your gains. But on the way down.
On the way down, it's a nightmare. When the price started tanking toward their liquidation mark, they had to scramble. They had to deposit funds back to the exchange to save their position.
Throwing good money after bad.
Basically. But in the process of trying to manage this collapsing trade, they lost approximately $747 million.
Just let that sink in. $750 million gone. And that wasn't just a paper loss. That was a realized loss trying to manage those margin calls.
And it wasn't just them.
No, we saw institutional pain too. Bitmine Immersion, a treasury firm, is sitting on unrealized losses of over $7 billion on their ETH holdings.
$7 billion. That is painful to even think about. But I want to play devil's advocate here for a second. We're looking at this wreckage, but is there a silver lining? I saw Thomas Lee from Bitmine arguing that this might actually be a setup for a recovery.
He's taking the historical view, which is valid. He argues that Ethereum often sees a V-shaped recovery after declines of 60% or more.
So the rubber band theory?
Basically, yeah. When the rubber band is stretched this far down, it tends to snap back violently. And we are seeing some data that supports a sentiment shift.
Are you talking about the derivatives data from TradingView? I saw that funding rates on BitMEX have flipped positive.
Right, and let's explain what that means. Funding rates are essentially the cost to hold a position. If you want to bet long that the price goes up, and everyone else does too, you have to pay a fee to the people betting short.
So when funding is positive,
it means the majority of the market is betting on the price going up.
And right now, they're sitting around 0.049%. That's pretty high, isn't it?
It is strongly positive. It tells us that traders are betting big on the recovery. They're willing to pay a premium to be long on Ethereum right now.
Okay, but I sense a but coming.
It's a big but. I have to add a warning here.
Lay it on us. What's the catch?
When funding rates get this high, this positive, it means the trade is crowded. Everyone is on the same side of the boat again.
Right. If everyone is betting on the price going up, who is left to buy?
Exactly. High positive funding rates often precede more volatility, not necessarily a smooth ride-up. It creates a risk of another flush if the price dips even a little bit, and those people get scared.
So it feels like we're walking a tightrope. The sentiment says buy, but the mechanics say be careful.
Precisely. And to understand why that rope is so shaky, we have to look at where the big money is or isn't flowing.
Which brings us to the ETFs. For the last year or so, the spot Bitcoin ETFs were the engine driving the price up.
The easy button for Wall Street.
Exactly. But looking at the data from this week, That engine is sputtering.
The engine isn't just sputtering, it's practically stalling. We've seen an exodus. According to the data, U.S. Bitcoin spot ETFs have seen 3 consecutive weeks of outflows.
3 weeks?
And in the week ending February 6th alone, the crash, week $358.5 million left the funds.
Wow! That's a lot of selling pressure. And it creates a really confusing picture. We just said that smart money on-chain bought the dip at 60K.
Right.
But the institutional ETF money is selling.
Right.
Who is right?
That is the billion-dollar question. The on-chain whales are buying, but the traditional finance investors are fleeing. To put it in perspective, total net assets in Bitcoin ETFs dropped from $128 billion in mid-January to $97 billion.
So that's billions of dollars of institutional support that just walked out the door.
It is.
And I wonder if that's tied to the broader economic data. The U.S. economic numbers this week were, well, confusing is putting it mildly.
Conflicting data is the theme of the week. On one hand, you have the labor market. Jobless claims jumped to 231,000. JOLTS job openings fell to around 6.5 million.
So in isolation, that's bad news. It signals the economy is weakening.
Yep. Businesses aren't hiring. More people are filing for unemployment. That brings those recession fears right back to the forefront.
But in the weird, twisted logic of finance, bad news is sometimes good news, right? Because if the economy is weak, the Federal Reserve might cut interest rates to save it.
Exactly. The market immediately repriced the Fed's next move. The probability of a rate cut in June 2026 jumped from 67% to 75%.
And lower rates are generally good for risky assets like crypto.
Because money becomes cheaper. If you can't get a good yield in a savings account, you might go buy some Bitcoin.
So we have a weakening labor market fueling rate cut hopes, which should be bullish. But then I was looking at the U-Hodler report, and they pointed out this macro misalignment regarding the PMI data. This really threw me for a loop.
This is one of the most interesting disconnects right now. The U.S. ISM manufacturing PMI, which measures the health of the manufacturing sector, unexpectedly surged to 52.6.
So anything over 50 means expansion.
Right. The real economy, at least the factory side of it, is actually growing.
Usually that's good for everything. If factories are humming, people have jobs, people spend money, asset prices go up.
Usually.
Yeah.
But crypto completely ignored it. U-Hodler's analysis is that the crypto market is currently suffering from tunnel vision.
Tunnel vision.
It's ignoring the good economic growth data because it's too focused on liquidity constraints and the structural weakness we saw with that leverage flush. It's focusing on the plumbing rather than the house.
That makes a lot of sense. It's hard to care about factory output when you're worried about your leverage position getting liquidated or Amazon spending $200 billion.
The immediate fear overrides the long-term data.
Correct. The market is hyperfixated on the now and the fear, missing the broader signal that the economy might actually be okay.
So with all these mixed signals, ETFs selling, smart money buying, factory data good, labor data bad, what is the actual outlook for the rest of February 2026?
Well, if we want to know what people are actually betting on, putting their money where their mouth is, we look at the prediction markets.
And Polymarket is giving us some very specific probabilities.
I love looking at Polymarket because it cuts through the noise. People lie on Twitter, but they usually tell the truth when they're betting actual money. What are the gamblers saying?
They're betting on stability. The safe bet right now implies a 54 to 74% probability that Bitcoin ends February above $70,000.
Okay, so staying above that psychological line. But what about the moonshot? Everyone always wants to know if we're going to see 85K or 100K next week.
The betting markets say probably not. The chance of hitting 85,000 has collapsed down to 29%. The optimism for a parabolic run just isn't there right now.
But on the flip side,
the floor looks solid. The chance of crashing below $55,000 is in the single digits.
So it sounds like the consensus is we survived the crash, we're going to chill between 65K and 85K.
Consolidation, that's the word. After a shock like we just had, the market usually needs time to lick its wounds and rebuild some structure.
Right.
It rarely goes straight back up in a straight line.
Speaking of rebuilding, it's interesting to contrast the short-term panic with how actual users are feeling about the long term. We have this survey from 1inch, the decentralized exchange aggregator. They surveyed 8,000 DeFi users.
Yeah.
You'd think they'd be freaking out after a week like this.
Surprisingly, no. The survey shows 72% are optimistic about 2026 as a whole, but there is a clear experience bias here that I love.
Oh, what's that?
The longer someone has been in crypto, the veterans, the more optimistic they are.
That tracks. I mean, if you've been here since 2017 or 2020, a 15% drop in a week is just
This
Tuesday.
is Tuesday. You've seen 80% drops. You've seen exchanges collapse. This is nothing.
Exactly. The newbies are the ones who get shaken out. The veterans are more concerned with infrastructure. The survey showed that gas fees remain the #1 annoyance for users.
Followed by security risks.
Right. They aren't complaining about price volatility. They're complaining about user experience.
Which is actually a very healthy sign for the industry. It means the core user base is focused on utility. Make the tech work better rather than just make me rich overnight.
It is. It shows maturity. Now, for the traders listening who are watching the charts like a hawk and don't care about gas fees right now, there are some technical levels we need to respect.
Yes, absolutely.
So lay out the battlefield for us. What are the lines in the sand?
For the bull case, to really say that we have reversed this bearish trend, Bitcoin needs to break and hold $75,000.
ETH.
That's roughly where the 50-day exponential moving average sits. It's a key technical resistance. If we can get above that and stay there, the trend flips back to bullish.
And the bear case, what's the danger zone?
It's $60,000. We saw that bounce off 60K on Thursday. That was the line in the sand. If we go back down there and it doesn't hold, if we break below it, the door opens to the August 2024 lows.
And where are those?
All the way down around $49,000.
Yikes. That is a massive air pocket. Falling from 60K to 49K would be catastrophic for sentiment. So 60K is the castle wall we have to defend.
Is the critical support.
So to bring this all together, it feels like we are in this strange limbo. We survived a massive leverage flush. The weak hands got washed out, and the smart money seemingly bought that dip at 60K. But the big institutional ETF money is still leaving the room spooked by the macro picture.
That's the summary. And for you, the listener, the so what here, is that we are in a moment of extreme fear regarding sentiment, but extreme confusion regarding macroeconomics.
Right.
Historically, buying when fear is at a 6 out of 100 is a profitable move. That's when the best entries happen. But the Amazon spending spree and the recession risks add a layer of complexity we haven't seen in a while.
It's not just number go up anymore. You have to watch what the Fed does, what Amazon spends, and what the whales are doing.
It requires a lot more attention. It does. And I want to leave you with a thought from that Holdler report that I just can't get out of my head. They said, narratives may improve before prices do.
Narratives may improve before prices do. That's profound.
Well, think about that. We have the manufacturing economy expanding. That PMI data we talked about, that's a good narrative. But crypto prices fell.
So are we looking at a broken correlation?
Or is crypto just lagging behind the real economy for the first time in this cycle?
That is a fascinating question. Usually crypto is the canary in the coal mine. It moves first, it crashes first, and it rallies first. If it's lagging now, that changes the whole playbook.
It certainly does. It means you might have to wait longer for the price to reflect the reality. It requires patience, which is something this market is notoriously bad at.
Something to mull over while you're checking your portfolio. And hey, maybe check your own fear and greed level before you make any moves this week. If you're feeling panic, remember the weak hands data.
And if you're feeling greedy, remember the ETF outflows.
Balance. We love to see it. Thanks for diving in with us. We'll catch you on the next one.
Stay curious.